Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and you're probably watching this on Saturday. But more importantly, you know that it's that day of the week that we bring in Jim Welsh from Macro Tides. Jim, how are you? Good to see you.
I'm good, Blake. I'm sure you feel like I do, that this week had 5 days. I feel like I've aged about a month. But if you're watching this on Saturday, hope your feet are up because I'm hoping my feet will be up too.
Yeah, and you brought a lot of good charts and a lot of great talking
Yeah,
points, and it's been a hell of a market this week. We've seen we're filming actually on a Friday, and at this very second of filming, markets are trading at their lows. They're trading at the levels that they were yesterday, 2 days ago, after post CPI. So I'm
yeah.
really interested to get your market thoughts as we head into this next week, based on the information that we got here this week.
Yeah. Well, again, as you and I have talked and what I've written about is I expected the CPI to come in hotter than expected. It would at least tick up by 0.2 from 3.2 to 3.4 and potentially 3.5 based on rounding, which is exactly, what happened. The core held steady. Well, it actually ticked from 3.75 to 3.8. So, but from the Fed's point of view, they want confidence inflation's coming down, and these numbers obviously don't provide that. Wall Street has then, since the CPI report, they're tripping over each other. Who can guess the lower number of Fed cuts? So we've gone from six, to four to three, and now it's less than two, I think. And as you know, our conversations have been, my belief was that the inflation would remain a problem, and that it would, the idea of a March cut was ridiculous. The idea of a June cut I thought was very, very unlikely based on what I expected, the inflation numbers. The PCE comes out on the 26th, so 2 weeks from today. And it's, again, I don't know that it's likely to go more sideways. So
Okay.
again, the Fed isn't getting confidence that inflation is trending down. And, that's what they've said they really need.
And I'm sure you're going to be answering this as we go through it, because I do have a couple of questions, but I won't ask them just yet.
Yeah.
We did have CPI. It's tax season, just so you
Yeah.
know. That was a Freudian slip for those of you that didn't know that.
That's
We
right.
have a CPA. We had CPI come in this week, but we had producer prices come in a little bit different. So I know
Right.
you want to talk all about this. So let's start off with your
Yeah.
first chart that you brought, and let's discuss the CPI, the headline number, the one that really kind of rocked the markets when we first saw it come out. So what are you seeing here, Jim?
Well, obviously, if you remember late last year, one of the rages was, oh, look at the 3 month, change annualized, or the 6 month change annualized. And those are the lighter blue numbers. And you can see going back to like October of 2022, the 3 and 6 month uh, dropped below the 12-month annualized rate. Well, now what we can see is since really June of last year, the 3 month has been gradually ticking higher. The 6 month kicked in a few months ago, and now both of them are above the 12 month. So I don't hear many people talking about the 3 and 6 months anymore. The thing I would point out is let's go back to last November, uh, because that was after we had seen some really low inflationary numbers. And I do believe that influenced a number of Fed governors at the December meeting, because that's where everybody thought, oh, the Fed's pivoted. And if you looked at the dot plot and so forth, they dropped. So my point being is that plunge, if you will, in the fourth quarter of last year of the 3 and 6 month below the 12 month influenced a lot of people, including the Fed. Obviously, now what we're seeing is, those are above, and again, not providing the kind of numbers that the Fed is hoping for and needs to see.
All right. Well, the next chart you brought, Jim, is the Supercore CPI. So explain to us what Supercore means.
Well, this is something that Powell brought up. They're kind of like, let's look at inflation and take out housing, because in the CPI.
Why? Because housing doesn't matter to
Yeah,
anybody.
no, because it does measure rents for apartments and anyway.
It doesn't
But that was
matter.
the idea.
You'll be fine. You'll be fine,
No,
Jim.
I'm
You'll
going
be
to offer why.
okay.
Yeah. No, the reason why he brought that up, I believe, is the lag time between the real world changes and the statistical machinations of the CPI. Where you can see the real, and we saw this in reverse in 22 and 23, where housing prices went nuts, rents went nuts, and yet the shelter component was kind of lagging severely. Well, now that they've come down a little bit, and they really haven't come down, rents are more like flatlining. So the annual rate of change is coming down, but no one's paying any less. And housing prices have actually been ticking higher over the last few months. But that's why he's, said, well, let me look at service inflation that excludes housing. And this is what he brought up. And what you can see is, again, the 3 and 6 month stuff has skyrocketed in the last 4 to 6 months. And this relates to service inflation. I've seen people say, well, if you look at services and take out auto insurance and a couple other items, it's really not that bad. Well, if you got a car, you can't take out the auto insurance. Cars went up in price significantly. A minor dent to the bumper costs you a couple grand because it's got cameras and sensor, whatever else. So anyway, it's just interesting that people that are, inflation is just going to keep coming down bandwagon. As soon as there's a number that doesn't jive with that narrative, well, let's poke holes. Well, if you exclude that one, well, it seems like every other month, Blake, there's an effort to exclude 1 or 2 items. Because if you take those out, the number isn't bad.
Yeah.
It's like, well, if it wasn't gasoline, it wouldn't be up. So, well, guess what? Most people drive a vehicle.
Right. Yeah, that's the thing. I happen to, I happen to live here in this real world, and these are the costs that I have as a human being. I mean, come on.
Yeah.
So,
Now in California, the gas is up to like $5.35 a gallon.
yeah,
Right.
and we're not far behind you.
California is about $1.30 to $1.50.
Yeah.
Above the national average. So
okay, so well, let's talk about what turned the market on Thursday, which would have been yesterday. Yeah. We saw the producer prices. So what is this? Is tell us.
This is one of those things where before the number came out, the S&P was down about 30 points, and the expectation was that it was going to go up by 0.3, and it only went up by 0.2. Hallelujah! All right. Some of this will feed into the PCE. So there was concerns after the CPI that, oh my goodness, if the PPI comes in hot, then the PCE will tick up. So, basically relief. But if you look at the seasonal adjustments, and all these numbers are seasonally adjusted, they're attempting to, smooth out seasonal changes, obviously, like in, Christmas. Retail sales are nuts. In January and February, they're much weaker. So how do you factor all that stuff out? But this is kind of an extreme where they said, well, gasoline prices were down 3.6%, but in the real world, for most of us, unadjusted, it was up over 6%. So my point is, when a detail provides a bullish argument, it's used to be bullish. Here's a piece of information that kind of said, that overreaction to the PPI was predicated on something that kind of says next month may not be so pretty.
Yeah.
And so that was one thing, okay? Because immediately the S&P went from down 30 to a flat.
Yep.
And then we're going to talk about Nvidia in a few minutes. And that was the other piece of the equation of why the market behaved the way it did, at least in my view, yesterday.
Okay. So, I was talking with a friend of mine who's been in the markets longer than me, and we talk all day long. And he had the same question that I had, because we were talking about producer prices, because we grew up in a market where we thought that, and this is where I want your feedback or your response. We grew up in a market where we're like, okay, well, PPI is kind of a leading indicator to what we're going to see in CPI. So isn't the inflation picture going to get better moving
Yeah,
forward? I mean, and that's what the markets responded on in our view,
right.
but isn't CPI more like backward looking in a sense? I mean, what's your response there?
Well, it's like a pipeline. You know, if you think about a pipeline,
Yeah.
at the beginning of the pipeline is the PPI. You know, what are the raw cost inputs, and then you get some manufacturing or some process done and so forth, and it ends up in the final demand, and then that will feed, obviously, as companies pass along price increases or something to the CPI. The one thing I would say, though, is manufacturing is 15% of GDP, less than 15%. Services are 80%. And so, you know, the average consumer lives in the CPI world. That's what they experience. So, you know, it's like you want to have a whole picture of the PPI and CPI are good to you know, if you're at an inflection point with inflation, you want to be looking at both buckets, would be my take. You know, um, I think the Fed puts more weight on the CPI. The PPI, again, there's aspects in it that will feed into the PCE, which is the favorite of the Fed's metrics. So that's why, to me, I wouldn't ignore it. To me, I want to look at all of this stuff, right?
Yeah.
Because it's like gears in a machine. You know, are they speeding up in terms of inflation, or are they slowing down? You know, I think we're going to see, I don't think we're on a cusp of a big uptick in inflation. Now, if oil prices take off, one of the things, maybe I'll include this chart soon, is a replay of the 1970s. You know, where there was a big inflation push at 73, 74. We had a deep recession, it came down, and then a higher push going into the late 70s, 1981. Yeah, but that higher push was because of oil prices.
Yeah.
You know, in 1973, oil was $3 a barrel. It went up to 12 in 74. And then it went up to 36 in the late 70s. So my point is, I don't think, now, is it possible that we could see oil at 250 or some number? Well, in a crazy world, things do happen.
Okay.
So anyway,
Fair enough.
enough.
Okay. Well, the next chart you brought is something that it didn't catch me off guard, thank goodness, but I know it caught a lot of people off guard and a lot of traders off guard. The dollar. So the dollar
Yep.
just ripped to new highs in the year. And I know
Yep.
what you dollar or what you gold bulls are going to say. It's like, well, the dollar is just ripping against other fiat currencies, but it's losing value in against everything else. Fine, I get it.
Yeah.
But you
Yeah.
still travel different places. The dollar is still moving against fiat or what? It's breaking out. What do you make of this dollar move, Jim?
Well, most trade is done in dollars as opposed to any
Sure.
other currency or any other commodity. All right. When we spoke last week, 2 weeks ago, I'm pretty confident we're getting above 104.97. Then last week, I think we're going to go up again above 105.10. And I threw out a number of 105.65. Well, after the CPI, it traded up to 105.53, pulled back a little bit. And then this morning and overnight, because of news out of the Middle East, in terms of, you know, something happening with Israel in terms of Hezbollah or Iran, you know, that really provided more juice for the dollar to push higher. So you asked me, you know, 106.71, because that's where A and C would be equal. The other aspect is of that, it rallied from 102.36 to 105.10. If you add that to 103.88, you get 106.62. So again, I wasn't dismissing that you could get higher, but I thought very confident we would see a pop at least to the 105.65 level because of the CPI. And, you know, so if you expected to move to 105.65 and it turned out to go higher than that, but you were wrong because you thought the CPI was going to come in hot, you're probably not crying.
No, not at all. At least I wasn't, Jim. So
I'm so glad to hear that.
Good. All right. Well, let's talk about treasuries and CPI.
Yeah.
Obviously, I mean, yields just ripped higher, and I think that was one of the big issues that most dollar traders had they're like, well, yields are going up, but the dollar's not following. But, obviously yields end up going up after CPI. But
Yep.
are we done here? Is this it?
Well, I think we're close. I mean, the one thing I will want to point out is, okay, we had the CPI. How did markets react to it? Well, the dollar rallied. Treasury yields jumped. I mean, 20 basis points in one day. That's
It's a big move.
huge move.
Yeah.
Okay. The market sold off. So to me, when we've spoken, I think we're going higher. You got higher highs, higher lows, and the price target or the yield target was around 450 to 460. It got to 459. You can see it kind of came up to a trend line. So to me, this is a place where yields can top out. Now, we need confirmation, obviously. We need to see momentum begin to become positive with yields coming down. But again, for weeks, we've been talking about higher yields, higher yields. I thought that the CPI would provide a boost to yields. All that's taken place. I don't think if something bad happens in the Middle East, you could see a 180 in Treasury yields where they reverse quickly.
Yeah.
Absent that, I think you might get some choppiness in this 450 to 460 range before we see a more decided move. Again, I think yields are going to come down a lot in the course of this year. I think the 10-year will drop below the lows that we saw in December and potentially make a move down towards the 340, 350.
Okay, so the next chart you have is TLT, and I know this is a trading vehicle that most people trade. Regarding the bond market yields notes, TLT is a fan favorite. So, what's your Elliott wave count tell you here?
Well, just a pattern. I mean, to me, in Monday's weekly technical review, said more and more to me, it's looking like TLT will get near the 618 retracement of the rally from last October's low to the December high at 89.35. Yesterday, it got down to 89.51. So again, to me, this is, the anticipation from my perspective was we were going to see this move down, and I believe we're near a bottom. Now, just like I said on the 10-year, you need momentum to begin to improve. And one simple trend following thing is a 5-day exponential versus the 13-day exponential. You can see as
the red
TLT
and green
came off the lows in October. Yes.
Okay.
Look at back in October, November, and then how it held the whole rally going up and then reversed. And then, there's swings and so forth. So, if you just were looking at this, you will see some whipsaws. There's no question about it. But anyway, at a minimum, after making this price low, Blake, it's important that we start to see momentum reverse. And then ultimately that upper downtrend line, it's got to break above that.
Okay.
So
that's a great little piece of information that you just gave everybody on the EMAs. So, the 5 versus the 13 period EMA. Good information, Jim. Thank you very much.
Yeah.
We'll be watching for that if those cross back over in any time in the near future.
Yep.
Then the next chart you brought is the Fed fund cut. Tell us what we're looking at here.
This is the blue line is the Fed funds futures.
Okay.
And what they were expecting the Fed to do. Mm-hmm. And what we can see is from October until, we got into January, remember it was like, hey, we're going to get 6 cuts, right? Yeah. And this doesn't show a lot of 2023, but as you can see, the S&P was working its way down into that low in October as Wall Street was still betting on the Fed not cutting rates. And then finally, those great inflation numbers out in October and November of last year, and then the Fed meeting of, hey, we may be able to, well, at least some people, believing that Powell had done a 180, which I was never in that camp. But we can see the divergence as Wall Street's been forced to take back, well, we're not going to get 6, we're not going to get 5.43, and now we're down to 2 or 1.5. And you've seen this gap develop between the Fed funds futures and the S&P. And we've talked about this. The reason why this is happening is because people are so convinced that the economy is going to be good. And if the economy is good, that means earnings are going to grow. And they've been really, kind of riding that coattail in terms of how the artificial intelligence story, but the primary one has been the economy. So one or two things are going to happen here. I think the gap between these two are going to narrow, with probably at some point in time, the Fed funds futures, start to anticipate maybe, again, I'm looking for the economy to slow as we get to mid-year and beyond. And if the economy has been the main reason why the S&P has been able to ignore what's going on with rates, if we've seen definitive signs that the economy's slowing, my take would be we'll see the S&P come down. And I still think that's a high probability.
Okay, so if the S&P is going to come down, it's probably going to be led by the next chart you brought, and you said you're going to talk about it, so let's talk about it.
Here we are.
Nvidia.
This is Nvidia.
Yeah.
Okay, so it's interesting. On Wednesday, April 10th.
Yep.
The CPI came out. Boy, oh boy, not good news. And on April 10th, Morgan Stanley came back and said, you know what? We really think Nvidia is a buy. We're raising our target from $795 to $1,000. So Nvidia didn't fall. And then yesterday, what we saw was Nvidia was up 4%. And so a lot of people pay attention, understandably, to this stock. And, why was the market up yesterday? Well, the PPI news obviously was the initial rebound off the S&P being down 30. And then when the market opened and Nvidia started to crank, the rest of the market followed through. By the end of yesterday, as we know, the S&P was up 38 points. And if you looked at how many stocks were up versus down yesterday, Blake, 40 more stocks were up than down. It was like 1411 to 1370.
Wow. So,
my point is, underneath the surface, the overall market wasn't that robust at all. Relative, it was weak. So again, for the market to have a meaningful decline, to your point, Nvidia is going to have to roll over. And if it takes out the lows, I think it was around 837 on the CPI report day, then that opens up the door to, something under 750.
Got it. So, okay. Well, the next chart you brought is the high to lows, New York Stock Exchange, S&P highs to lows. So tell us what you see here.
Yeah, this is to me a really good indicator. If the market's healthy, what happens is more stocks are going up over time. Then more stocks make 52-week highs.
Yep.
And there's very few stocks that make a 52-week low. And what you can see is the 5-day exponential versus the 21-day, in this case, exponential, of that differential. And, look off to the left, and you can see after the market bottomed in March of last year, there was a nice uptrend in this high-low indicator that then broke down in August. Well, that, the slope of the trend line from January, I should say, looks very similar. And we can see that on April 2nd, the 5 fell below the 13-day, and obviously both are trending below that blue line. And so to me, this is just a trend following way of saying, all right, what's different? Well, it's behaving more like it did last August than any time since then, really. So that suggests that I think the market is more vulnerable to a deeper correction than what we've seen, at least going back to December.
Okay. Well, the next chart you brought is the S&P key reversal chart. So tell us what that's all about.
Well, key reversals are when an index or a stock makes a higher high than yesterday, a lower low than yesterday, and then closes down. And so to me, it's a little bit of a sign of exhaustion where the buyers have just run out of gas. And there was a big key reversal on March 8th, and then a second one on April 4th. One of the things I discussed in Monday's weekly technical review was, again, going back to July and August of last year, Blake, and showing how there had been a series of key reversals. So now every major average has had at least one key reversal, with the Dow, transports, S&P, Qs, the semiconductor all having two, and then the New York Composite Value Line Composite had theirs on April 4th. So again, this just to me says selling into strength. And the 5 and 30, this is a 2-hourly chart. So, but if you looked at a daily chart and you threw the 5 exponential and 13 exponential on it,
Yeah.
you'd see that, man, that uptrend, they beautifully supported the uptrend. And now, really, for the first time since late last year, or maybe even the October low, the 5 is coming below the 13. So for me, this is all evidence that there's more downside risk. If you take out the 5137, which I think we did right before you and I were starting to talk.
Yep.
You know, that red horizontal line is around 5100. There's a low there at 5091, 5104. You get a real close below those levels, then you're talking about, I think, much more weakness. My guess would be you get not down near 5100, look for a bounce. But ultimately, I think the odds favor we're going lower. Now, the only thing I will say is if we don't take out that area around 5100, we're going to get a bounce. And then we'll just have to see, is that bounce going to be just a bounce prior to another down leg? That's my bias.
I hate to put it all on geopolitical risks over the weekend, but hey, if hopefully, I pray if everything we get past
Not
the
praying for one
weekend,
thing or the other. Yeah.
there's no major events, we're probably going to end up bouncing on it to kick off the week. So
You're right. I mean, in other words, relief in terms of, oh, okay, a lot of people didn't die over the weekend. Yippee, so yeah, you're right. But like I said, I think those key reversals, in my view, mean something.
okay,
And
well,
that's not a positive. All right.
right.
So
Yeah, okay. And you know what everybody wants to know is where the hell do you think gold's going? Because gold has been on this absolute tear, and I
yeah,
mean,
yeah.
I
Well,
just saw a headline: Goldman revised their upside forecast for this year for 2,700. But here's the thing, Jim. Speaking about a reversal, we saw as we were coming on air quite a big reversal intraday.
okay. Yeah, I haven't been looking. I don't know if it got higher than 2415. I put these charts together like 2 hours or so ago.
We got
You
just
know,
a smidge above 2415, and we're trading down at 2370. So we
yeah,
have already
yeah.
given back all of our gains basically on the day. So we're trading
Well,
down here. So anyway,
okay.
what do
Well,
you
in
see?
Monday's weekly technical review, my thought was that you could see 3 waves up, and I thought we'd see more strength going into the CPI report, that the CPI report would cause a modest decline for a wave 4, and then there'd be another push. So potentially, with that script has been followed. I think we're going to see a pullback in gold, but geopolitical events could make a huge difference. But just looking at the chart, how overbought it is, sentiment is starting to get, when Goldman and the other Wall Street firms start raising targets, you got to assume you're probably near a short-term high.
Yeah, that's funny. That's was the comments that I've seen on social media. And again, I'm seeing it. You had taken this chart about 2 hours ago, but yeah, the upside forecasts were just raised just moments ago, and I saw a lot of people saying, "Well, the top's in." But it's
Yeah.
interesting because we did get this bearish reversal
Reversal.
intraday, and we're trading down at the lows. So it's
Yeah,
been a hell
yeah.
of a ride. And if you've been a gold bug this whole time, which I know there's a lot of them that listen to this particular show, you've been happy, and it's been a great ride. And
Yep.
so you
Yep.
need
Yeah.
to
I
think
mean, as
about
you know,
that,
I
right?
I was positive, 2, 3 months ago, like, okay, we had wave 1 up May of last year. Wave 2 pullback, moving above 2,300. The only thing is it's happened much more quickly than I expected.
Yeah.
But that, for me, reaffirms that, all right, we're going to have a short-term high. We'll probably do some dancing around for 3, 5 weeks or whatever. But I think the probabilities are that the economy is going to slow more than expected. The Fed will be cutting rates. And I think gold would like that very, very much. So in
Well,
other words,
and
pull
we
back.
haven't seen that weakness yet, Jim. I keep
It's
waiting
coming,
for it.
baby.
What's that?
It's coming.
Well, you know what? We also, you know what else is coming? May. And when May comes, we sell in May and go away. Maybe this season is a year that actually happens. But I want to thank you, Jim, for walking us through the markets this week. You're a godsend to so many traders. And if you enjoyed, listening to Jim, give him a thumbs up. By the way, if you didn't understand that PPI CPI concept, maybe you should jump down in the comments below and chat with Jim about it a little bit down below. Subscribing to the channel to hear Jim is free to do. It's also free to give thumbs up, and it's also free to actually hit a bell icon. So this way you're notified every time Jim's interview comes out versus waiting for some social media post to figure out when his interview is. So Jim, what's the best way for traders to follow your work?
Macrotides.com, or send an email to jimwelshmacro@gmail.com, and I'll send you a recent report.
Great. Jim, I want to thank you so much for spending your time with us. You like I said, you're a godsend to the trading community. I look forward to our conversation next Friday. Have a wonderful weekend, everyone.
Thank you with your generous, and that would be a G, godsend with a very small G, okay?
Thanks, Jim.
You.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.